Hi, and welcome to this week's look back at the major stories that have been impacting the market in the last few days. And we're going to start for once with a commodity. And Brent Crude Oil seems to be on the up. Now, November the 26th saw the bottom of Brent Crude around $76.28 per barrel. Pretty much though, since then the price has been increasing, which isn't great at this time of the year. On Monday we saw a high of $81.41 a barrel. That's $81.41 a barrel. Now around lunchtime today it was trading around $78.50, so it has eased off slightly. But what's behind this increase? Well, primarily end of last week, the EU set a price cap of $60 per barrel for Russian oil as a form of a limit on Russian seaborne crude oil. Now, at the time, the market price was $79 per barrel. Thus, funnily enough, the Russian companies refused to sell to EU countries that were adhering to the cap. Thus, we've seen a decrease in supply and, of course, at this time of year, a bit of an increase in demand. Now, the Russian energy industry has warned the cap could cause havoc on the energy markets and the price of oil, and it appears as though they might be correct. Now, the EU have said that this cap will be reviewed regularly to monitor its impact on the markets, and that the cap should be at least 5% lower than the market price. The question to ask here is, are Russian firms going to accept that and sell at a discount to the market? Well, probably not, particularly with such a globally traded commodity such as oil. So I think it's fair to say volatility is here to stay in the oil market in the coming weeks. Keep your eye on it, keep your eye on the news. All of these factors come into play on the price of oil. Okay, for our second look, we're gonna stay in the UK, and unfortunately, UK's recession bites again. We're gonna look at cable. We're gonna look at sterling. After a long period of declining values in the late summer and autumn, where we saw lows of 118s on closing, in fact, even intraday lows slightly below that, November proved to be a good month for the Great British Pound. We had an unstable short-term government and a catastrophic budget that hit the pound hard, as did inflation. But at the end of last week, we saw 1.24 versus the US dollar. That's despite the gloomy economic outlook that still hangs like a cloud over the UK. But this week, things have turned down again. On Monday, the CBI told CNN that the UK faces a lost decade of low growth if action is not taken quickly, and that Britain is in stagflation. The director of the CBI said himself. That's high inflation, reducing growth. On top of this, we've also now got wage depreciation coming into play. Now, whilst that's slowed in the last quarter, it's still one of the largest levels since metrics were first used back in 2001. Well, what does it mean? Well, obviously, wage depreciation means there's less purchasing power out there for members of the public, obviously leads to lower demand for goods and services. It's quite clear that bearishness is an inevitable byproduct of these issues that are going on. We're currently bouncing around the 122 mark, so we've come off that 124 high. Not really seeing, an absolute collapse in sterling, but certainly keep your eyes open. Certainly remember your risk management techniques. There's lots more news and information coming out in the next few weeks, and it's quite clear that sterling is in for a bumpy ride. Okay, for our third story this week, we're going to jump across the pond to the US, and the S&P 500 closed lower for the fourth day in a row earlier this week. Are those recession fears biting again? Tuesday's close was its lowest point in 4 days. It lost 1.44% to close at 3941.26. At the same time, the Nasdaq was down 2% and the Dow Jones Industrial Average down 1.03%. It was mainly bank stocks which were hit the hardest, and some media companies. In terms of the banks, that's concerns of unserviceable debt with increasing interest rates, etc., and inflation. Now, whilst US inflation is lower than the UK and the EU, obviously large US corporations, banks, technology sectors have large operations in the UK and in the EU. So rising inflation over here means they have to spend more money to maintain their positions. Now, the fall meant the S&P was down 3.2% this week, and at the moment there's no real sign of significant recovery. At the same time, the Nasdaq is down 3.9% on the week. The Fed is still looking at interest rates, well, they've been slightly more conservative comments coming out compared to the UK and the EU, but it's relatively evident investors have still not ruled out the possible recession, even if it's not likely to be as bad as the UK and the EU in the coming months. Finally, for this week, we're going to stay in the States and something which may possibly add a little bit of filler to those companies we've been talking about in the last story. And that's the Pentagon this week signed a $9 billion contract. On Wednesday, the Pentagon announced it's awarded cloud computing contracts to Amazon, Google, Microsoft, and Oracle. The total cost of these services could reach $9 billion up to 2028. Now, there is a history to this story. Back in 2019, the Pentagon awarded Microsoft as the sole service provider for these cloud computing provisions. But Amazon sued and Oracle expressed dissatisfaction, whatever that means, and thus we've finally come to fruition of the whole process. Now, this provides some serious fundamental analysis support to these heavy-hitting tech companies. The cloud businesses of them will clearly develop in the long term with this sort of input, these types of contract, particularly to a body such as the Pentagon. However, recession concerns are still being aired by analysts, and they are definitely still in play, as we've seen based on what we've talked about in terms of the indices in the last week or so. From a technical analysis point of view, the shares look slightly overbought. If we look at the weekly Oracle chart, the price has reached the upper limit of the descending channel, and technical analysts would say that may well form a bearish reversal. So these things aren't clear cut. Look at your fundamentals, look at your technicals, use your risk management techniques, and invest with care. Wish you luck with your trading week ahead. We'll be back next week to cover those big stories. Bye for now.